Hello investors, it's Sil from Equitymaster bringing you investing insights to make investing simple and easy to learn. To stay updated on investing trends and the latest developments on Indian markets, don't forget to subscribe to this channel and like this video. In today's video, I'm going to talk about 5 fundamentally strong mid-cap stocks that could turn into large-cap stocks in 2025. In stock markets, the balance between risk and reward is the key to success. You can make higher returns by investing in small caps and micro caps, but it comes with high risk and volatility. On the other hand, large cap stocks are known for their stability and resilience, but their growth rates can be lower, often lagging behind the broader market. That's where mid-cap stocks come in. Mid-caps fit in the sweet spot between reasonable growth and good stability. Identifying mid-cap stocks that can transform into future large caps gives good compounding returns in the initial years. When they finally transform into large caps, they provide stability to the portfolio. Keeping that in mind, I'll highlight the 5 mid-cap stocks which can turn into large caps in 2025. Before we move on, please note this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. With that disclaimer out of our way, let's get started. First on our list is Solar Industries. The company is primarily involved in the manufacturing of industrial explosives and explosive initiating devices for the mining and defense industries. The company manufactures a comprehensive range of products, including package emulsion explosives, bulk explosives, and explosive initiating systems. In FY24, Solar Industries' turnover was Rs 6,070 crores, marking the highest ever EBITDA and profit after tax at Rs 1,410 crores and Rs 880 crores respectively. The company's defense segment's annual revenue surpassed Rs 500 crores for the first time. The company continued its strong performance in FY24, recording its highest ever quarterly EBITDA and PAT at Rs 480 crores and Rs 300 crores respectively for the most recent September 2024 quarter. Solar Industries management anticipates top-line growth of around 30% for FY25. They expect the defense revenue to grow threefold in FY25, reaching around 1,500 crore rupees. The company's order book stands at over 5,700 crore rupees as of November 2024. This includes 3,350 crores from defense and Rs 2,200 crores from explosives. The company achieved record-breaking EBITDA margins in Q1 and Q2 of FY25, reaching around 27%. The management expects it to improve from the current levels in FY25. Due to the strong order book and anticipated growth, the company is revising its annual capital expenditure guidance upwards from Rs 800 crores to Rs 1,200 crores for FY25. The company is expanding into new international markets like Kazakhstan and Thailand. It has introduced high-tech explosive and is expanding its product portfolio to include loitering munitions and anti-drone technology. Solar Industries has also acquired ProBlast in South Africa and Rajasthan Explosives in India, highlighting their growth strategy. The company aims to be debt-free by the end of FY25. Here's how the stock price has performed in the past 1 year. Moving on, second on the list is Persistent Systems, a global technology company specializing in software products, services, and technology innovation. The company provides digital engineering and enterprise modernization solutions for clients across a range of industries. The company is on a rip-roar upward momentum both in terms of earnings growth and stock price. It achieved its 18th consecutive quarter of quarter-on-quarter revenue growth in Q2 of FY25. The company's revenue reached $346 million in Q2 of FY25, representing an 18.4% year-on-year growth and a 5.3% quarter-on-quarter growth. In rupee terms, the growth was 20.1% year-on-year. This strong performance was driven by growth in the healthcare sector. The high-tech vertical has remained stagnant for the past few quarters. The Midcap IT company's management is confident in the growth trajectory, citing a strong start to FY25. They expect significant margin improvement by the end of FY25. It has set an aspiration to reach the 14.5% earnings before interest and taxes margin achieved in the previous financial year. The company is continuing to invest in the comprehensive AI strategy, focusing on both AI for technology and AI for business. Artificial Intelligence for Technology centers around the company's AI-driven platform, SASVA, is designed to optimize and automate various aspects of the software development lifecycle, such as code generation, security assessment, backlog management, and release planning. SASVA 2.0, the latest version of the platform, expands its capabilities to cover the entire software development process, from ideation to post-deployment. Whereas AI for business is aimed at helping enterprises leverage AI to enhance their operations and customer experiences. Persistence has also developed platforms like Gen AI Hub, providing clients with access to generative AI solutions, and iAura, an AI-powered data solution for data-driven decision-making. All these initiatives make the company future-ready and lay a solid foundation for transitioning to a large cap. Here's how the stock price has moved in the past 1 year. Moving on, third on the list is Indust Towers. Indust Towers is India's largest telecom tower infrastructure company. It deploys, owns, and manages telecom towers and communication structures across India. Indus provides access to its towers primarily to wireless telecommunication service providers on a shared basis under long-term contracts. As of 31st March 2024, Indust Towers owned and operated 219,736 towers with 368,588 co-locations across 18 telecommunication circles in India. Although revenue growth was muted with 0.8% year-on-year growth in FY24, EBITDA grew 50% year-on-year to Rs 14,694 crores with an EBITDA margin of 51.4% in FY24. The net profit grew by 196% year-on-year to Rs 6,036 crores in FY24. This financial performance is attributed to the company's enhanced network expansion, improved customer relations, and disciplined financial management. The management expects the growth momentum to continue in the current year due to the accelerated rollouts by one of its major customers, especially in rural areas. They anticipate network expansion by a major customer providing good growth opportunities. The management sees growth opportunities from increased demand for new sites to aid network decongestion, which is expected to arise as networks mature. There is expected demand for Indust Towers' other offerings, including in-building and small cell solutions, which they believe will grow as the telecom infrastructure landscape evolves further. Indust Towers anticipates that incremental tenancies will flow through from its other major customers as well as in the near-term future, further contributing to the growth. The management has indicated they have a strong order book and expect the growth momentum to continue in the next few quarters. They expect margin improvement later in the year as energy margins are typically impacted by seasonality in Q1 and Q2, with a recovery expected in Q3 and Q4. Vodafone PLC recently sold off its 18% stake in Indust Towers. Nevertheless, Indust Towers completed the buyback of 56.8 million shares at a price of 465 rupees per share during Q2 of financial year 25, increasing Bharti Airtel's ownership in the company to more than 50%. The company is well positioned to leapfrog to the large cap status in the coming years. Here's how the stock price has moved in the past 1 year. Fourth on the list is ICICI Prudential Life Insurance. a major player in the Indian life insurance company. It is a joint venture between ICICI Bank, a major Indian financial institution, and Prudential Corporation Holdings, a part of the UK-based Prudential PLC group. ICICI Prudential Life is one of the largest private life insurers in India. It had a market share of 6.6% in terms of individual annualized premium equivalent and 4.8% in terms of overall new business premium in FY24. In the September 2024 quarter, the company achieved robust growth in its key premium matrix. Retail weighted received premium grew 33.9% year-on-year, exceeding the growth rates of both the private and overall life insurance industries for 4 consecutive quarters. The annualized premium equivalent increased 26.8% year-on-year to Rs 4,470 crores, driven by strong growth in both retail and group segments in first half of FY25. New business premium expanded by 18.6% year-on-year. The company saw sustainable growth in these strategically important segments. Annuity APE grew 99.5% year-on-year, driven by the introduction of innovative products like the Benefit Enhancer. While retail protection APE grew 17.2%, fueled by the company's expanded distribution network and product offerings. Value of new business increased 4.2% year-on-year to Rs 1,060 crores. The VNB margin was 23.7% due to the shift in product mix towards unit-linked products and declining GSEC yields. The embedded value grew by 19.4% year-on-year to Rs 46,020 crores. The company's assets under management have reached Rs 3.2 trillion. The insurance company aims to maintain its growth by focusing on absolute VNB growth, which will depend on APE growth and maintaining healthy margins. ICICI Prudential Life plans to continue investing in its agency and direct channels, leveraging its training programs, technology platforms, and micro-market strategies to drive consistent growth. It wants to expand its protection and annuity segments. These segments represent significant growth opportunities, and the company aims to strengthen its product offerings and distribution reach to capitalize on their potential. With rising insurance penetration and the company taking the right initiatives, it looks to become a large cap soon, meeting the huge demand for insurance in India. Here's how the stock price has moved in the past 1 year. Moving on, the last stock on the list is HDFC AMC. The company offers a variety of financial products, including actively and passively managed mutual funds, portfolio management services, and alternative investment funds. HDFC AMC serves the investment needs of a diverse customer base, from retail investors to large institutions. They have a physical presence in over 200 cities through a network of 254 branches and also maintain modern digital platforms. For the quarter ended 30th September 2024, the net profit of the company increased 32% year-on-year to Rs 577 crores. Revenue grew by 38% year-on-year, reaching Rs 887 crores. Operating profit surged 47% year-on-year to Rs 688 crores. During the quarter, quarterly average assets under management stood at Rs 75,880 crores, giving HDFC AMC a market share of 11.5%. Also, HDFC AMC holds the largest market share of 12.9% for actively managed equity mutual funds. The mutual fund industry has seen consistent growth in systematic investment plans, and HDFC AMC has benefited from this trend. In September 2024, the industry saw SIP contributions of Rs 24,500 crores, the highest ever. HDFC AMC's focus on long tenure SIPs with 87% subscribed for over 5 years suggests stable and predictable future flows. HDFC AMC has been actively building its alternative investment platform, including the launch of Category 2 AIF. As of 31st March 2024, they had received commitments of around Rs 8 billion for this fund. This represents a potential growth area for the company. The inauguration of HDFC AMC International Limited's office in GIFT City in August 2023 marks a strategic move to tap into international investors and offer global investment opportunities to Indian investors. While still in its early stages, this expansion holds significant growth potential. By embracing the financialization trend, the company is well placed to move up from a mid-cap to a large cap. Here's how the stock price has moved over the past 1 year. So there you go. These were some mid-caps that have the potential to grow and turn into large caps in 2025. Mid-cap stocks offer a compelling opportunity for investors seeking a balance between the high volatility of small caps and the slower growth of large caps. By identifying promising mid-caps early, investors can potentially reap substantial rewards as these companies scale new heights. While mid-cap stocks hold significant growth potential, they are not without risks. Investors should conduct thorough due diligence, keeping an eye on financial health, management quality, corporate governance, and competitive positioning. Diversification across sectors and a long-term perspective are crucial to mitigating risk associated with mid-cap investments. As always, investing in equities requires a careful assessment of one's risk tolerance and investment goals. That's it for today. Don't forget to like this video and share it with your friends and family and make them as smart as you are. Have a profitable day and happy investing.